So I wanted to welcome everyone to our event this evening with Professor Karnit Flug, who needs really no introduction. She was a guest of ours this time last year, former governor of the Bank of Israel, now at the Israel Democracy Institute, and as it says, at the Hebrew University. Now, for those of you who were here this time last year, you may remember that Professor Flug said that as long as there's no war between Israel and Lebanon, things should be reasonably okay. 12 months later, of course, that's not the case, but maybe actually the incredible outcome of that brief war with Lebanon changes things to the positive rather than to the negative. We've got a few topics that I wanted to cover this evening, which really focus on the outlook for the Israeli economy. And that will inform, of course, impact on our investments and on our lives here in Israel. But I did have a quick question to start with for Karnit, which isn't one we discussed before, so I'm going to ask you off the cuff. But anyone who read Hank Paulson's book about the great financial crash of 2008, or Andrew Ross Sorkin's also book about the great financial crash of 2008, can probably remember that the main thesis they put forward was it was the coordinated actions of central banks in 2008 that saved the global financial system from collapse. The coordinated action of central bankers. And it made me think when I read in the papers that Mark Carney, the former governor of the Bank of England, is proposing to run as Prime Minister of Canada, whether the coordinated action of former central bankers means that Karnit's going to be running for Prime Minister of Israel in the near future. And this is the start of another coordinated central bank response. And I'm judging by the laugh that probably isn't going to happen. So I'll meanwhile introduce everyone to Professor Flug, and we'll start off with a question of how you see the outlook for the Israeli economy.
Okay, so good evening, and it's very nice to be here again. And let me start with some indicators of where we were just before the war and where we are now, and then we'll move forward. So if we look at the trend of growth, you can actually see that before the war and after COVID, the trend was we were at the level of GDP which was higher than the long-term trend of GDP. So the recovery from COVID was remarkable, and then of course came the decline starting in October, and we'll talk about the recovery then. When we look at the labor market, actually the performance of the labor market is quite remarkable. This is the unemployment, and it's at the lowest point that it has been in 2 decades. Unemployment is remarkably low, and it's not because of low participation, because also the participation rate is high and the employment rate is high. So what's behind the extremely tightness of the labor market? It's partly the economy is recovering, but it's partly also shortage of workers, shortage because of Palestinian workers that are not allowed to work in Israel, and because of foreign workers that many of them left at the beginning of the war. Some of them came back, but there's still shortage, and also because of reservists that are still serving in the army. So we have tight labor market. Actually, when we look more closely at the unemployment level, so when you add to the sort of traditionally defined unemployment, which is at the lowest, as I said, in 20 years, you add to that people that are absent due to economic reasons, and that is mostly around the borders in the north and in the south. And if you add to that people who serve on reserve, the green point here, we're still at a very tight labor market, okay? And that shows up also in wages. Actually, wages, in overall wages, which is the blue line, started recovering actually since the beginning of 23, partly because of the tightness of the labor market. There was some decline even in the real wages because the inflation accelerated. So initially, when inflation accelerates, wages, which continue moving up according to previous trend, are eroded in real terms. But then when there is a realization that actually inflation is higher and labor market is tight, we start seeing an acceleration in the growth of nominal wages. And when you look at the business sector, actually real wages, which means adjusted for inflation, have been going up quite rapidly. We don't see the same in the public services, because in the public services, they're mostly the wages are the result of negotiations between the Histadrut and the government. They lag, in the last 30 years, they lag after the wages in the private sector, but the agreements usually mimic what is happening in the private sector. This time, there is an agreement that was signed, but as part of the adjustment in the fiscal adjustment, now there is going to be a freeze in the wages of the public sector. So what we see is that it hasn't recovered, and it's not expected to recover in the near future because of the wage freeze that has been agreed. Not yet, the budget has not passed yet the Knesset, but that's part of the budget plan. So this is the way the labor market looks, and the bottom line is that wages in the private sector are going up. They're also adding to fueling of inflation. And this is inflation. So before the war, actually, inflation, as you know, went up everywhere, right? In the US, in the OECD, all OECD countries, and also in Israel. In Israel, more modestly than in the rest of the advanced economies. But then inflation started coming down. It started coming down also in Israel, but this deceleration of inflation actually stopped because of the war and the supply constraints that are associated with that. So part of it is related to what we've seen before, the wages, and the fact that actually wages are going up because of absence and because of the shortage of labor. And there were also some areas in which there were very specific supply constraints. For example, as you probably all know, flying, the price of traveling abroad, fruits and vegetables that are mostly grown around the borders, an increase in the cost of marine travel, how do you say? Shipping, yeah, thank you. And so there are all kinds of supply constraints that actually led to this upward tick in inflation. I think there is a good reason to expect inflation to start decelerating now because these supply constraints are being eased. We've seen actually some decline in the cost of shipping, of marine shipping. Yeah. I wanted to be very precise. And we've also seen some decline in oil prices, and I think with the easing of supply constraints of labor, we will start seeing also some deceleration in the wages. So right now, inflation is still above the target of the Bank of Israel, but it is expected to ease. Okay. In terms of activity, this is a sort of daily indicator of consumption. These are credit card purchases. The data is coming daily, so you can actually see the trends very quickly. And what actually here, the blue line is in real terms, so it's corrected for inflation, and the orange line is not in nominal terms. What you see is the very sharp decline initial in October, but then you see a very quick recovery thereafter. In nominal terms, full recovery, but still inflation is higher. So when you look at in real terms, it's still lower than the trend. But when you look at the level of credit card spending, it's about 5% higher than it was before the war. So consumption has recovered. It's not booming, but it definitely has recovered. Exchange rate. So the exchange rate, actually, I have to say that if somebody would have told me that we would have a 14 months, 15 months now, long war, and that the exchange rate would be roughly where it was before the war, I would be very surprised. But the strength of the shekel is very surprising. It actually, if I would have shown here a much longer term graph, what you would see is that in the short run, the shekel-dollar exchange rate was very, very closely correlated to the S&P 500. And the reason for that, and that's beyond all the fundamentals that are behind the strengthening of the shekel that I'll mention in a minute. But the short-term effect of the trend in the S&P is related to the fact that institutional investors invest abroad, but when the valuations of the stock markets in the US go up, they have to reduce their exposure to foreign exchange, okay? So that means that they're actually selling for, buying shekel, yeah, and that actually offsets the higher exposure that results from investing abroad, and therefore that is what explains the short-term strong correlation between the S&P and the shekel. Now, this correlation was to a large extent broken in the beginning of 2023 when the judicial reform was announced and there was a lot of noise in the market. And so we've seen actually a weakening of the shekel after that and a breakdown of this correlation. Then with the breaking of the war, there was additional strong devaluation of the shekel. It was halted not long after that, I think with the aid of the announcement by the Bank of Israel that it is willing to support the shekel. It said that they are willing to sell up to 30 billion shekels, dollars, in order to avoid a very sharp depreciation. They also had additional $15 billion that they were willing to do swaps for. So I think that is basically the fears in the market. And then what we've seen since then is more or less stable shekel-dollar exchange rate. If you would look at the old correlation between the shekel and the S&P, what you would have seen that the shekel should have been much stronger. So although for us, I didn't look today, but 3.6 seems very strong shekel. But if it would have followed the correlation with S&P, would have been much closer to somewhere between 3.2 and 3.3. So it looks very strong, but there are forces that make it strong, including this short-term correlation, beyond the fundamentals of current account surplus and surplus in terms of assets in foreign exchange, and still attractive high-tech sector that again attracts now foreign investors. So this is the exchange rate. In terms of risk premiums, there are different measures of risk premiums. If we look at the credit default swaps, which is sort of the measure of how the market assesses the risk of Israel. What you can see is the jump on October 7th, and some decline after the ceasefire in the north, but the level is still higher than it was before the war. So that's sort of one measure of risk. In terms of the stock market, so you probably follow it quite closely. Again, there was a close correlation between the Tel Aviv 124.25 and the S&P 500. That correlation was also broken around the election day of beginning of 2023, when the Israeli stock exchange started lagging behind the S&P 500. You can see here, actually, the green line is the difference. We've seen the gap actually growing after October 7th. But recently, as you have seen, Israeli stock markets actually are booming, and this lagging behind has narrowed significantly. And actually in 23, the increase in our stock market surpassed the increase in S&P 500. So it seems that the market is very optimistic about the recovery of the Israeli economy. One more measure of risk is the gap between the 10-year bond yield of Israeli bonds versus the US bonds. And what you can see here is actually, it always amazes me that there are long periods in which it seems like the risk of Israeli bonds is lower than the risk of the US bonds. You can explain it maybe by the debt to GDP ratio that in Israel is lower, but still I find it quite amazing. The gap became significantly positive after the beginning of the war, but then started actually moving up, and then declined back recently after the ceasefire. So the ceasefire seems to be a point at which, first of all, I think the market expected to become permanent in spite of the talk around it, and the market behaves as if the situation has actually stabilized in terms of the fighting. We see that in all the indicators. The markets believe in the ceasefire and its effects going forward on the rebound of the economy. That's basically what I take from here. One more short-term indicator is the capital raising by high-tech companies. Of course, you're all aware that there was a huge boom after COVID, actually coming out of COVID everywhere, not only in Israel. There were huge investment in technology after COVID, actually even during COVID, and more so with the recovery from COVID. There was a sharp decline everywhere, not only in Israel, in the capital raised by high-tech companies in 2022 and in 2023. The decline in Israel was somewhat sharper than in the US, for example, during this period, again, probably related to the judicial overall. And then we see some, actually, after a decline, again, in the last two quarters of 23, we see some recovery. There is a discussion to what extent it's broadly covering all the sector, all the high-tech type of companies. It's fairly concentrated in few sectors, especially in cyber security, in defense or defense-related. But still, the numbers are quite impressive. There is quite a recovery that I think, again, thinking of 15 months of war, I think this picture is actually quite a positive surprise.
Okay, so thank you for that backdrop. Of course, history is a wonderful thing, but what we're more concerned about is what's going to happen going forward. What's the outlook for the local Israeli economy for 2025 and beyond? Can it pull out of the challenges that have been created by the war?
I think the first thing when you ask the question of what's expected after the war is looking what happened after previous wars or other shocks to the economy. And you might have seen this picture before, but there are a few quarters added since. And I would say that one of the very strong characteristics of the Israeli economy is its resilience and its ability to bounce back after major shocks. And that's true when you look at all these are all military operations / limited wars, I would say. And you can see, for example, after the Second Lebanon War, when you look at the annual numbers, you actually don't see any effect. It's sort of, the bounce back was sort of washed away the effect of the war. And that was true after almost all the military operations before. The recovery following COVID was remarkable. I don't know if you remember, but in 2021, the economy grew by 8.5%, and then in 2023 by 6.5%. I mean, remarkable numbers. And the question is, where are we going now? And I think it's still too early to judge, although there are signs of recovery, but we're still at war. So it's too early to say that we see a strong bounce back, but we do see signs of recovery. I did talk about the strengths of the labor market. By the way, one period that we've seen that was much more difficult to get out of was the second Intifada, which was a very long period with a lot of terrorist attack throughout the country. There were some other, there was also global slowdown, so we also, I should always remind myself that we're also dependent on the global economy. So this is a period where the weakness was actually much more prolonged, and I think it's too early to say in a very sort of convincing way that we're out of the woods. But still, I think there are few attributes of the Israeli economy that are behind the resilience that we have seen, and I already mentioned a few of them. We have a surplus in the current account of the balance of payments, which make us more resilient, basically, to shocks. There is a surplus of assets over liabilities in foreign exchange. That's the result of many years of current account surplus. We had a low public debt, which is very important because it allowed the government to react strongly to shocks. And that was true during COVID, and that was true also during the war. So the government, because of the relatively low debt to GDP ratio, has the fiscal space to react strongly to any shock. We have a stable financial system, which means that the banks and overall financial institutions can play the role of basically mitigating the effects of a declining of income for some time on their for both household and firms. We have a very innovative, dynamic public sector, and we have a central bank that has the reserves so it can actually intervene when it needs. as we've seen at the beginning of the war, it was willing to sell US dollars, I mentioned already, and that just the willingness and the announcement, I think, was enough to stabilize the market. So I think these are sort of the main pillars of the strengths of the economy. When we look at what is projected for the Israeli economy by the OECD, you can see here in blue Israel, and in black is the average of OECD countries. It's important because we have to remember that Israel is a small, maybe not so small, open economy, and we're also dependent on the global economy. In 2023, actually there was an effect of 1 quarter on activity, so we grew by, I think it was 2% actually, and not 1.9. The OECD projects, it's still a projection because the final numbers are not in yet, but 2023 will end probably with growth rate of about 0.6 or 0.5 or 0.6%, which is, okay, I should actually put something in parentheses when I show this, this graph. Our population grows much faster than the average OECD country, so growth rate of 0.6% is a decline in per capita income. So the comparison here should be sort of, there is an asterisk there. And that's what they expect for 2026. But 2025, for this year, when you look at the range of projections, it's actually quite wide. And the reason is that I think everyone who makes projections have different thinking about where the war is going. So the most pessimistic are Moody's, actually, I think. Yeah, Moody's, which also gave their, made their projections in September. So I think their expectation was that the war will continue dragging for longer. But as you see, there is a wide, and I would say there is a broad uncertainty, and that's why there is a wide range of projections. Usually at the beginning of the year, you already see convergence of the projections, but we haven't seen it yet. I think if I have to sort of say, my expectation is that we will be at around 4%, maybe even higher, assuming that the ceasefire holds. And I think when you look at the indicators and you see the behavior of the economy and the way it bounces back following a period of stress, I think these projections by the Bank of Israel or by the Ministry of Finance are the most sort of, in my view, most realistic.
Okay, thank you. A lot of numbers and a lot of figures to digest. There were 3 that really struck me. The first was that in 2008, Israel was hardly affected by the global financial crisis, which was devastating to major world economies, the USA, Europe and the USA. Took a massive battering, and Israel almost just like brushed it off like some dust on a jacket. The second was how inflation here was so much lower, 2022, on the back of the Russian invasion of Ukraine, whereas much of the Western world had double-digit inflation. Here we barely reached half that. And the third is, of course, the outlook for the economy going forward, which seems to be, for this year and next year, hugely positive. And that's going to, I presume, would expect to be reflected in asset prices and in the currency. So going forward, there are 2 key institutions, if you want, or levers that are impacting what's going to happen. First is the Bank of Israel. The second is the government of the State of Israel. So what's the Bank of Israel, your alma mater, been doing to try and make sure we steer through these choppy waters?
Yeah, so I'll say a few words about what the Bank of Israel has been doing to sort of help mitigate the effects of the war on households and on businesses. So I mentioned already the foreign exchange intervention and the willingness to intervene, so I'll skip that. And I'll only mention the programs to defer loans, especially for victims, family, people around the border, and reservists. So there are all these programs. Some of them are still going on, or of basically alleviating the need to actually service the debt. And that's true also for small businesses. At the initial stages, early on during the war, there was also an instruction by the banking supervisor for banks not to issue dividends, so as to make sure that they have enough capital to be able to continue actually providing credit even if things get worse. Since then, I think banks have been doing very, very well. So the distribution of dividends resumed. But I would say generally that the fact that banks here are very well capitalized, and we have a very conservative supervision, makes it possible for them to actually take all these steps and continue providing credit and providing relief in terms of credit during period of stress. So I think in that sense, they played a very positive role. Looking forward, so this is just taken from the latest Bank of Israel announcement on the 6th of January. So this is what, the projections. These are the projections by the research department. They expect an inflation rate for the 4 quarters ahead of about 2.6%. You can see that it's within the range of between the capital market and private forecasters. And they talk about 1 or 2 interest rate reductions during the year, which is, I guess the market is slightly more optimistic. They're expecting 2 and maybe slightly more than 2 reductions a year. I think according to the announcement by the Bank of Israel, they continue placing quite a lot of weight on stability, on stabilizing the market, although now it seems that at least in terms of the main market, the foreign exchange market is quite stable. And in fact, the strengthening of the shekel, I think, will make it easier for them to reduce the rate. And also, I think there are signs, as I mentioned before, of lighter supply constraints. And if these constraints are continued to be eased, I think it's quite likely that we will start seeing inflation coming down and will allow the Bank of Israel to reduce interest rates, maybe getting towards the middle of the year. But yeah, that's sort of what I think is a reasonable expectation. So that's in terms of monetary policy. What about fiscal policy? I think here there is quite a lot of drama, I would say. We started the government, we entered the war with a debt to GDP ratio of 60%, which allowed the government to increase spending dramatically with some increase in prices. We've seen the increase in risk premium, but there was no difficulty to finance. But the question is, what is the burden that the costs of the war and the increase in defense spending means going forward? So we ended the year relatively okay with okay, given that we've been in a war, with a 6.9% of deficit to GDP. Okay, this graph is taken from the Ministry of Finance monthly report about the government finances, and each bar shows what is the deficit in the last 12 months. So actually in September, when you looked back for the last 12 months, the deficit was at 8.5%. It included the huge costs at the beginning of the war. When you move forward, some of these months are already out of the calculation of last 12 months, and we ended the year 24 with a 6.9% deficit, very large, but we see some diminishing of the deficit. And the government target for next year is a deficit of 4.4%. I should say that 4.4% is much higher than the level of deficit that will stabilize the debt to GDP ratio. So what we're going to see, we already saw in 24 a jump in the debt to GDP ratio to 69%. That was published, I think, 3 days ago, something like that. And we're going to see a further increase in the debt to GDP ratio in 2025. I would say this is the most important, in terms of the public finances, this is the most important figure. And I think the market will be watching to see whether we start seeing a beginning of a decline in the debt to GDP ratio. I should mention, in 2020, during COVID, you can see that deficit went through the roof to 11%, but it came down very rapidly, and the debt to GDP ratio, which jumped to over 70%, went back to 60% because of the relatively rapid decline in the deficit and a very strong growth of 8.5% in 2021. I don't expect to see that going forward, partly because the deficit is expected to continue be quite high because of the mostly because of the additional defense spending. One positive sign is the fact that actually tax revenues continue to go up according to trend. And you can see that actually direct taxes, which are taxes mostly on income tax and on profits, they're actually above trend. Taxes on indirect taxes, which are mostly on consumption, are slightly below. But overall taxes are actually booming, which helped limit, we think that the deficit has started going down, and it's partly because of the booming taxes. So that's the sort of positive development in terms of the public finances. When we think about going forward, when we think about fiscal policy, there are a few things that we should bear in mind. It's just a reminder. One is we have, of course, very high spending on defense. This is Israel 2023. It's going to go up further. And we have very, very modest civilian spending on education, health, infrastructure, and so on, is relatively very modest in Israel. So I think it's important to bear in mind when you think about the government fiscal policy going forward, that where we are in those two areas. By the way, the defense spending, again, looking back, when there was always a discussion between the Ministry of Defense and the Ministry of Finance regarding defense spending. And the numbers that the Ministry of Defense would always show would be these numbers. The defense spending relative to GDP has been going down for many years. the Ministry of Finance would always show these numbers, which is in real terms, defense spending has gone up quite significantly. And this is, I mean, we're now at the point where the question is, where is defense spending going to go? I think the Ministry of Defense would like to fix it in terms of as a proportion of GDP. That is not going to happen. But this is just to sort of get the sense of where we are, where we were. When you look over a long period of time, actually the decline in the defense and interest on government debt in terms of GDP were translated into lower debt and into lower overall spending. They were not translated into higher civilian spending. And so I think the challenge now is if you have, again, higher defense burden, how you're going to finance it. It's going to be very hard to finance it by further reducing civilian spending, because as you've seen in two graphs before, the civilian spending in Israel is very, I would say, stingy. And it's going to be hard to sort of reduce it further. Okay, overall spending on defense during 23 to 25 is about 272 billion. And I think more important is where are we going in terms of the defense spending forward. And this is a chart based on the Nagel Committee recommendation. I think the bottom line is that according to the Nagel Committee, which gave a recommendation, but I think it's going to be followed, the overall defense budget is going to go up by 270 billion shekels over the next 10 years, which is an increase of about 2.7% of GDP each year. Okay, so it will be, you'll have to somehow finance it. And one of the things that the Nagel Committee actually failed to do is, and they were requested to do according to the terms of reference, is to identify sources for this additional spending. It's not part of the current budget plan. It means probably higher taxes. It's going to be very hard to reduce, as I said, civilian spending. So that's a very significant challenge going forward. 25 budget. It has not been approved yet. As you know, the government has until the end of March to approve it. If it's not approved, the government falls. So there are efforts now to sort of get it through by the Knesset. What has been approved so far are the tax measures that are actually listed here. So the main tax measures in order to reduce the deficit for 2025 are the taxes on undistributed profit. Are you familiar with the term? Okay. And that's supposed to yield over 9 billion shekels. There is the public sector wage cuts, which is part of the budget. It's not on the revenue side, so it's still in discussions until the budget is approved. We have an increase in the Social Security tax and the freezing income tax increase. This is actually freezing of the tax brackets. You know, the tax brackets here are normally, I mean, by law, they're indexed to inflation. So there was it's virtually an increase in taxes. And I think the overall package here, if the budget goes through as planned, which it has not yet gone through. The deficit is going to be, as I showed before, around 4.4%. However, there is an additional spending already recommended by the Nagel Committee, which is not here, about 6 billion for 2025. So that, again, would need to be financed. Very substantial measures, and that's only for 2025. When we think about the budgets going forward, they will have to come up beyond all these measures with additional about 27 billion per year, yeah, roughly, which is very substantial, very challenging. So what hasn't been done? I mean, I've shown here the budget plan as it is. There are some pieces that I think are missing from that budget plan. You know, I think I talked about the coalition funds, the coalition budget, which is basically mostly for the ultra-Orthodox, for their education system. There was a very partial cut in those resources in the 25 budget. And there are all these superfluous ministries that have not been cut, have not been shut down in spite of an intention to shut some of them down. I have to say that these two would not yield huge amount of resources, but I think are important to sort of increase the trust in the way the government runs its business in the current difficult circumstances. I talked about the security, additional resources. I have to say that one of the troubling, I think, things regarding the Nagel Committee was that there was no discussion of what is the basic scenario for which the defense budget needs to be to meet. What are exactly the challenges that it needs to meet? They worked very condensely in a very short time, so that's an issue. They didn't identify resources to offset the additional defense spending. And also, one of the things that the government in its proposal does is basically have flat cuts, and it has very hard time to actually identify or make a change in its priorities. And the easiest thing when you don't want to sort of get into discussion with specific interest groups is to have a flat cut. It's not the most efficient, but that's what governments tend to do. I think I'll stop here maybe and leave it for questions.
Great, thank you. Thank you very much, Karnit. I did notice as everyone was getting a bit nervous, certainly the taxpayers, at the thought of tax rises because of increased military spending. One person around the table who works for Elbit seemed pretty happy about the outlook for their business without looking in any direction. Does anyone have any questions for Karnit on issues that she hasn't covered so far?
A very large part of the economy is actually the housing market. And so given the fact that there seems to be a disconnect between the rising prices of residential property and wages, the connection between the two seems to be getting completely out of kilter. Is there any danger of looking at a 2008 scenario like we saw in the US and Europe?
I think you're right that there is a disconnect in the sense that the affordability, housing affordability gets harder and harder for people. And the fact that, I didn't talk about that, but one of the sectors in which the shortage of labor is the most pronounced is in the construction sector. Which used to rely on Palestinian workers mostly, some foreign workers. There was some increase in foreign workers. Palestinian workers are not allowed in. So I think the issue of affordability is going to be a political issue. It's not the 2008 in the sense that I think that our mortgage market is relatively conservative. There are a lot of restrictions on what is the level of mortgage that you can take. Housing prices are not going to fall down. If anything, they will continue going up. And the restrictions on interest payment to income and loan to value, all of these make, from a financial standpoint, I think it's less of a risk. It's a risk in terms of affordability, which can turn into a political problem once again, which, by the way, which was the beginning of the 2011, how do you say, demonstrations and crisis, yeah.
Okay, thank you.
Could you understand? I mean, it's like clear as that labor shortage is putting pressure on the economy. Also, what is the logic of not letting in, I don't know, Indians, let's say, into the country and just build those roads and very cheap, just like Dubai did?
Well, the government tried to actually alleviate all the restrictions on bringing in foreign workers. It hasn't been very successful in actually bringing them in. So I'm not sure if it's because people think of Israel as a war zone and therefore are reluctant to come here. You know, there were quite a number of incidents of foreign workers in the north and in other places who actually got hurt. Generally, in the past at least, the government put a lot of restrictions, in my view, correct, with a good reason, on bringing foreign workers. I think the circumstances now have changed. There is also a discussion about letting Palestinians with clearance, with security clearance in. So I think it's a debate that has to take place.
They actually took off some restrictions?
They took off some of the restrictions on foreign workers, yeah. There is still a special tax that you have to pay. I'm not sure if it's called a tax, but there is still a
permit.
Yeah, in order to get a permit. I think the issue of Palestinian workers will have to be again discussed. Yeah.
Well, there are plenty of others. There is no shortage.
Globally, you're right. Yeah.
They're cheaper.
You showed the average inflation rate at 2.6%.
Expected.
Expected. I mean, can anybody relate to that? What is the basket that makes up the inflation rate? What do they use as the parameters to
In order to
establish the inflation rate? Because it sounds incredibly low.
To me, it doesn't sound incredibly low. I have to say that during my governmentship, I couldn't raise inflation to 2%. So that was my made. But what is it based on? I think it's based on an assumption that the shekel will not be devalued. In fact, we've seen now a trend of strengthening the shekel. That by itself exerts downward pressure on prices. The pass-through from the exchange rate to inflation has gone up quite significantly. So that on itself is a downward pressure on inflation. And then when you look at prices that actually of energy and of some other elements are going down. One thing that will raise inflation temporarily is the VAT, which started at the beginning of this year, and also prices of utilities. But this will be a one-off, and then there is no reason to expect it to sort of accelerate inflation afterwards.
Is housing included in the inflation?
Housing services are included, not the price of homes, but basically the CPI includes goods and services. It doesn't include assets. houses are an asset, and what in most countries the CPI includes housing services, which are measured by rent.
Rent.
Yeah. It's 25% of the basket, by the way.
Two questions. One of the last slides mentioned defence spending, but there was a rider at the bottom which said it excluded any grants that come from America for the billions that have money. How is that actually figured into the equation? Does Israel actually have to pay that back? Is it a grant from America?
It's a grant.
So it's money that's America simply gives.
Since I don't remember, a few years back, in the past there was part which was a grant and part which was a loan, but it was over the last few years it has been converted to grants only, and most of it has to be spent
In America.
So effectively we are paying for it.
Excuse
If
me?
it has to be spent in America, effectively we are paying for it.
Yeah.
The other question is, talking about inflation, the cost of foodstuffs have increased because of the reliance upon all the kibbutzim and moshavim in the north and the south that have been effectively shut down because they haven't got the foreign workers. Surely that's had an effect on the inflation.
Yeah, that's mostly in the fruits and vegetables, and actually we've seen an increase in the price of fruits and vegetables because most of the Israeli agriculture takes place either in the north or around the Gaza Strip. So yeah, it has actually pushed
So is that just 2%?
the overall inflation, the weight overall, the weight of food in the CPI, in the basket, I think is around 14%, if I'm not mistaken. Yeah, so it went up much, it went up
Certain
more
sectors
than...
are much higher. It's the balance which not everybody sees.
I think that generally there is a tendency, it's something that is documented, to focus on prices that you see frequently and that go up. Normally, we don't focus on prices that go down. So it's always it's interesting that there is this difference between the CPI, how it's measured, not only in Israel, also in other places, and what people think. Yeah, it's what you meet in the supermarket and the things that you spend, frequently on. This is what forms your view on inflation, but it's only part of inflation. Yeah, I can tell you that price of clothing have been going down now for years and years, and nobody notices that. Not that I buy clothing so frequently, but still.
So can I ask one question?
Yeah.
On one of your slides, it was the growth forecast. I kind of noticed that the finance industry in the Bank of Israel was about 4 and above, but everybody else externally was about 2.3.
You're right.
Is that Israeli optimism or?
I think it's a combination that some of these projections were made earlier on and didn't internalize the likelihood that there will be a ceasefire. I think both the Bank of Israel and the Ministry of Finance expect basically the ceasefire to hold. And there is also the optimism. I think if you look at the slide that shows what happened after every shock and after every war, you see that the economy has this tendency to bounce back. And I think it's internalized more in
So
the...
OECD haven't seen your presentation then, is that what you're saying?
Great. I think we'll bring things to a close because I know some people wanted to get away by 8 o'clock. So just I think it leaves it for me to thank Professor Karnit Flug very much for a really, really informative presentation. To thank everyone else for coming. There's still drinks and refreshments outside if you want to stay and chat a little bit longer. And look forward to seeing you all again at our next event. Have a great evening.
Thank you.
Thank you.